Welcome to the Ontario Mortgage and Real Estate Insights Podcast, your go-to source for the latest developments, trends, and regulatory changes in the industry. I'm your host, Steve Hamelin, here to provide you with insights sourced from reputable news outlets to help you stay informed and make well-informed decisions. This podcast is brought to you by Real Approved Inc., a trusted mortgage brokerage dedicated to helping Canadians achieve their homeownership dreams. Visit realapproved.ca to learn more about how their experienced team can assist you with your mortgage needs. Let's dive into today's episode. Today we're discussing a significant development in the Toronto real estate market. The mortgage delinquency rate in the Greater Toronto Area has reached a 9-year high. According to data from Equifax, the delinquency rate has been climbing steadily, marking one of the sharpest increases in history. This situation is unfolding just 2 years after the rate had hit a record low, illustrating a dramatic shift in the market dynamics. For those unfamiliar, the mortgage delinquency rate is the percentage of total mortgages that are at least 90 days past due. It's often seen as an important economic indicator, though it can be misunderstood. A rising delinquency rate does not necessarily mean that households are struggling financially. In a hot market, distressed sellers can sell their properties before their mortgages become delinquent. The real issue arises when borrowers can't sell their properties quickly enough, indicating a lack of market liquidity rather than consumer financial health. The current delinquency rate in Greater Toronto has risen by 14.3% to 0.16% of mortgages in the second quarter of 2024. This is double the rate from the same quarter the previous year and represents a 166% increase from the record low in 2022. Such a sharp rise suggests a significant shift in the market environment. What's particularly surprising is that this increase is happening despite policymakers taking extreme measures to prevent delinquencies. Lenders have been encouraged to extend mortgages to create multi-generational amortizations, among other strategies. Yet the rate continues to rise more sharply in Toronto than the national average, highlighting the unique challenges facing this region. The situation in Toronto is a clear sign of the market's current struggles. While some commentators like Sid Goldstein suggest that Toronto's real estate market is facing a long correction period, others believe that flushing out speculators could restore healthy growth. This divergence of opinions underscores the complexity of the market and the varying factors at play. Today, we're diving into the factors that could influence mortgage rates in the coming months. The trajectory of mortgage rates is a topic of significant interest for both homebuyers and industry professionals, as it directly impacts affordability and market dynamics. Recently, analysts have identified 4 key factors that could determine whether mortgage rates will continue to drift lower. First, we have the economic growth outlook. The state of the economy plays a crucial role in influencing mortgage rates. When economic growth is strong, central banks may increase interest rates to curb inflation, leading to higher mortgage rates. Conversely, if the economy struggles, central banks are likely to lower rates to stimulate growth. At present, the Canadian economy is showing mixed signals, with some sectors rebounding, while others face ongoing challenges. Another factor to consider is inflation expectations. Inflation erodes the purchasing power of money, and central banks typically raise interest rates to combat rising inflation. If inflation expectations remain anchored, mortgage rates may continue to drift lower. However, any significant uptick in inflation could prompt a shift in monetary policy, resulting in higher rates. Third, we have the global economic environment. The interconnected nature of today's global economy means that events in other countries can influence Canadian mortgage rates. For instance, if major economies like the United States or China experience significant economic shifts, it could impact global financial markets and, in turn, affect Canadian rates. Keeping an eye on international developments is essential for understanding potential rate changes. Finally, the actions of central banks, particularly the Bank of Canada, are critical in determining mortgage rates. Central banks use interest rates as a tool to manage economic growth and inflation. The Bank of Canada's decisions regarding rate cuts or hikes will significantly influence mortgage rates. As of now, the bank has signaled a cautious approach, balancing the need for economic recovery with inflation concerns. In summary, The future of mortgage rates will be shaped by a complex interplay of economic growth, inflation expectations, global economic conditions, and central bank policies. For those in the real estate market, staying informed about these factors can provide valuable insights into potential rate trends. As always, it's crucial to remain vigilant and adaptable in the face of changing market conditions. Today, we're focusing on why loan-to-income ratios and switching will be central topics in the mortgage markets in 2025. As we look ahead, it's clear that Canada's mortgage outlook is influenced by various factors, including potential policy changes from new governments both within Canada and across the border. While many uncertainties remain, there are some key trends and forecasts we can discuss. First, let's talk about the Office of the Superintendent of Financial Institutions loan-to-income rule. This regulation limits the percentage of mortgages that can exceed 4.5 times a borrower's gross income, though the exact limits can vary by lender and are kept confidential. This creates a hit-or-miss scenario for mortgage approvals, especially for those with higher loan-to-income ratios. As we move through 2025, these limits could become even more significant if interest rates drop by another 100 basis points, potentially making loan-to-income ratios a more critical factor than the government's current mortgage stress test. Next, the real estate market is expected to receive a boost in the spring. Several factors contribute to this positive outlook, including relaxed mortgage insurance rules, income growth, improved market sentiment, and downtrending interest rates. Additionally, regional supply bottlenecks and pent-up demand are likely to drive home price gains, with some analysts predicting increases of over 4%. However, these gains are not guaranteed given the uncertainties surrounding interest rates, which remain a significant wildcard for the market. We also need to consider the impact of debt on homeowners. Although debt service ratios have slightly declined, they remain near record highs. Non-mortgage debt, such as credit cards and auto loans, continues to grow, adding financial pressure on consumers. This situation may lead many to seek more affordable housing options, often further away from major city centers, especially as work-from-home arrangements continue to be prevalent. Switching mortgage providers is anticipated to be a significant trend in 2025. Many borrowers face payment shocks when renewing their mortgages due to rates that are 200 or more basis points higher than their previous agreements. This situation is expected to drive a wave of mortgage shopping as borrowers compare rates more aggressively. New rules allowing borrowers to switch lenders without passing the federal mortgage stress test will further encourage this trend, prompting lenders to offer more competitive renewal rates to retain customers. Finally, cross-selling strategies are likely to intensify rate competition among lenders. Many deposit-taking institutions are willing to offer significant mortgage discounts in hopes of cross-selling other financial products like savings accounts, credit cards, or investment products. This strategy benefits consumers as they receive better rates without being obligated to purchase additional services. However, it poses a challenge to monoline lenders that do not offer a broad range of financial products, potentially leading to a more competitive lending environment. As we greet the new year, it's a prime opportunity for mortgage brokers to set fresh goals and resolutions, aiming to strike a balance between business ambitions and personal well-being. Much like popular resolutions to improve personal health, the brokering world also takes this time to reflect on the past year and plan for improvements. Many brokers are focusing on streamlining processes, setting volume targets, and enhancing client experiences. The downtime is often used for setting up automations, implementing new customer relationship management systems, creating checklists, and time blocking to ensure a successful year ahead. However, reflecting on the past year can sometimes be daunting. It's easy to focus on what went wrong rather than what went right, especially when comparing ourselves to peers celebrating their accomplishments. If you didn't meet your goals in 2024, it's crucial to remember that surviving a challenging year is in itself an achievement. We must take stock of areas for improvement without dwelling excessively on past mistakes, as that can hinder forward momentum. In the mortgage industry, much like in personal fitness, the initial excitement of new goals can fade if immediate results aren't visible. It's important to recognize the unseen gains and non-financial victories that set the stage for future success. Patience and perseverance are key, especially when transitioning to self-employment, where the correlation between immediate effort and financial reward isn't always direct. The beginning of a new year can also bring anxiety, as brokers feel like they're starting from scratch. The pressure to meet volume and income goals can be intense, compounded by recent government announcements and regulatory changes. Navigating these changes, while dealing with the usual end-of-year stresses, can lead to burnout. It's vital to acknowledge the continuous nature of business development rather than viewing it as a reset. Achieving a true work-life balance is another challenge for brokers. The idea isn't just about scheduling time off, but allowing life to happen without work constantly intruding. Self-care shouldn't be another task on the to-do list, but a genuine effort to disconnect and recharge. It's about finding time to live and enjoy the personal aspects of life without work overshadowing everything. This year, many brokers are setting resolutions that prioritize personal life over business targets. Embracing genuine self-care, rekindling friendships, and dusting off old hobbies are becoming central to achieving a more fulfilling life. By focusing on living well, brokers often find that business success follows naturally. The new year presents an opportunity to thrive, not just survive, and to measure success in more ways than just financial achievements. Thanks for tuning in to another episode of the Ontario Mortgage and Real Estate Insights podcast. We hope you found today's insights valuable as you navigate the world of mortgages and real estate. Before you go, a quick reminder: Real Approved is here to make your mortgage journey smoother. Whether you're buying your first home or refinancing, their experienced team is ready to guide you with personalized support every step of the way. Visit realapproved.ca to get started and take the next step toward achieving your homeownership goals. Catch you next time, and stay informed with the latest industry insights.